Hi guys, welcome to the last episode of this series where I'll dive into why I believe financial planning is important, how I started my finance journey, and how you can too. Once again, I'm not a financial consultant, I have nothing to sell you. I'm just a young adult who's been researching quite a bit and already in his investing journey. So if that's it, whatever I'm about to share is not financial advice, I'm not certified in any way, so please treat my sharing as nothing more than inspiration to get you started on your own journey. So I think we can all agree that saving is important. But I think investing is more important, especially if you're still young and don't have much expenses to pay like your housing rental or raising children. So why do I say that investing is more important? It's because right now, if you put your money in the bank, the current interest rate that you get on average is around 0.2 to 0.5%, and considering that inflation is very high at a figure of 8% right now, you're essentially just losing money in your bank. So finding avenues to grow your money is actually a wise choice, and you can do this through investing. But of course, there's no free lunch in this world. Investing comes with risk as well, so I will address some safer avenues that can get you started. So I also believe that it's best to start as early as possible while you're still young, because the earlier you start, the longer time you have to keep your assets invested. This is known as a time horizon. And to elaborate further, every year you keep your assets in the investment, you are taking advantage of the compounding effect, which is the exponential returns that you get year on year. For example, assuming that you put $100 into a scheme that generates 8% per year, each year's increase is going to be larger than the previous year. So as you can see, the longer your time horizon, the greater your exponential returns. Of course, this is assuming that whatever you're invested in is generating profits and not losses, which can happen too. And this brings me to my next point, choosing what to invest in. I'm only going to touch on the stock market because that's the most accessible form of investment for most people. So how do you decide which stock to buy? The safest strategy for beginners is to just buy index funds. So the easiest way to think of index funds is just a basket of stocks from multiple companies. So for example, take the most popular index fund, the S&P 500. It is a basket of the top 500 US companies. So when you buy one stock of the S&P 500, you're actually buying 500 companies at one go. So what this means is that you're spreading your risk across all these companies. Furthermore, the S&P 500 throughout its existence since 1957 has consistently generated an average of 10% year on year. And while this might sound too good to be true, it's simply because the top 500 US businesses get bigger and earn more money over time, which leads to an uptrend eventually. With that said, you have to have a long-term mindset and be okay with seeing losses in some years. So yeah, I believe that the S&P 500 is a good place to start because it's really one of the safest instruments out there, especially if you're still young and have a long time horizon. So how do you even go about buying some? I suggest you can just Google Robo-Advisor Singapore. There's plenty of platforms for you to choose from, and most of them have a really intuitive onboarding experience to get you started. But of course, do your own research. Now you might be asking, how much should I put in and how frequent? I think the answer varies between individuals depending on your income and how much you have to spare after paying all your expenses. But frequency-wise, it would be good not to dump a lump sum but spread it out. I recommend a weekly basis because the purpose is to take advantage of the highs and lows of the market. So sometimes you might be buying at a high and other times you might be buying at a low, and eventually you'll be buying at an average price in any given time period, which is the best thing you can do since nobody can predict the movements of the stock market. So let's say you want to dedicate 20% of your monthly income to investing, you can consider splitting it up into 4 buys and put in 5% every week. So this brings me to the end of my sharing session on investing, and I like to end it off by recommending some really good educational mediums that I myself have benefited from. Go and check out Graham, Stephan and Andre Jig on YouTube. They are by far the best financial education channels out there, and they were the building blocks of my journey in financial literacy. I hope you found this episode useful. This brings me to the end of my 5-part series, and it was an enjoyable time creating the videos. I hope you've taken away some valuable learnings for yourself, and let me know if you'd like to see more. Bye!